for money, money, and money, money, making crack for money, money, yeah.
Welcome back to the Money Guys 2025. Lawrence and I, the Money Guys, are hanging out here at the game room down at Soho on Broadway. Very cool space. I've never been here, but we're hanging out and we're getting ready to kick off our 2025 podcast. Lawrence, welcome.
Thank you. Can you believe that it's 2025?
Yeah. So we are a little behind schedule. We meant to do this in January.
Yes.
But here we are. We're going to get this knocked out. We haven't got together since we had Orlando over in one of his properties back in December, and here we are. It's February, and we're getting this one knocked out. So, looking forward to a new year and putting out as much information on building a rental real estate portfolio, flipping real estate as we can here in the St. Louis marketplace.
Here, and I think we put out some quality content.
Yeah. But today's about us. We're going to talk about us today.
Yes.
Lawrence and I sat down and we started thinking, we talk about everybody else and what they do. We haven't given enough time to what we do. So we want to spend a little bit of that time today explaining again what exactly each of us do, how our roles fit hand in hand. And I'll get the legal stuff out of the way since somebody might be watching. Frank Rizika, Team Rizika Guild Mortgage, licensed loan officer, NMLS number 232528, licensed in the states of Missouri, Kansas, Illinois, Tennessee, Ohio, and Indiana, just to keep things legal.
Not as much legal on my end as needed. Of course, I'm Lawrence Hopkins. I'm the Regional Business Development Director of the Longhorn Investments. We're a hard money lender, and what we do exclusively is provide purchase and renovation money for our clients. And I tell you what, the reason we had to get back to where we are now talking about ourselves is based on the feedback that we've gotten from a lot of our clients. And I really appreciate all of the views that we got, all of the comments. It's really helped us and is really going to help us transition in the future to provide you guys some quality content.
Yeah. It's confusing. People are like, okay, you do this podcast with this guy. Who is he and what does he do? I don't understand. The beauty is what we do really fits together perfectly. You find a property that is in need of repair. It needs to be upgraded. Lawrence is the guy who will loan you the money to buy it and fix it up.
Correct.
And that's whether it's a fix and flip or a buy and hold.
Correct.
Right.
Yes, absolutely. We're a short-term bridge loan lender, and what we do exclusively is provide purchase and renovation for investors. And typically, we fund 100% of the purchase and renovation. And with hard money, it's a little more expensive than a traditional bank or mortgage company. But what we can do is it's a lot easier to get into our product, and that typically we only want to see a 600 credit score and a small amount in reserves. And also, once we get you into underwriting, it typically only takes us about 7 business days to get you through the process. So oftentimes investors will run into wholesalers that want to close extremely fast. So we can facilitate that. We're the mechanism that can facilitate that. And we did a great job in 2024. I think we funded a little over 28 or so $million just here in the St. Louis market. So I'm very proud of that. And I say this almost in every podcast. I'm born and raised in St. Louis, and I love the work I'm doing. And I consider it a pleasure to be able to serve so many real estate investors, both new and seasoned, in the St. Louis market.
Yeah. And so where we come into play, if you are that investor who's buying the property, fixing it up and flipping it, I would love to be the guy who provides the end financing to the home buyer. There might be incentives or grants or some kind of money that's available on that home that you as a fix and flipper don't even know about. Anything from $3,000, $5,000, $6,500 in available funds that can help that end buyer, making it a better transaction all the way along. The other side of that coin is if you are a buy and hold, I'm the guy who can provide the long-term financing once you're done with Lawrence. Our guidelines are different, but the key is whether you're doing a fix and flip or whether you're doing a buy and hold, I would say get a hold of me early on in the process to let's try to figure out what's going on with that property that might make more sense uh, to flip it or to hold it. And there might be some financial incentives involved on one or the other that you might not be aware of.
Right. And one of the things that we do as a lender, Frank, even though our requirements are relatively easy compared to yours, if we're funding a buy hold transaction, our advance rate to our borrowers goes up a bit, but we want to see a pre-approval letter
From a lender.
from a lender. Absolutely. So obviously, if they meet your requirements and they
Then they
provide,
meet yours.
then they meet our requirements. Absolutely. And you don't want to get into a hard money loan or anything like that, private loan or anything without having some type of exit strategy in place. Got to have that exit strategy. So we ask for your exit strategy up front.
And it's cool if you have multiple exit strategies, right? You might get into a project that you think is going to be a buy and hold and it turns into a great flip, or vice versa. But having multiple ways out the door is always nice. One of the things that I do want to emphasize, because it's big news for us this year, is we're bringing DSCR loans in-house. And for those who aren't familiar with it, a DSCR loan is a loan where we're basically making the loan based on what the property can generate in rent relative to the debt. We don't collect tax returns. We don't collect W-2s. We don't collect pay stubs. We don't need any of that because none of that is going to justify doing this loan. What justifies doing the loan is the rent, potential rent or current rent that's being generated from that property. So if you see an opportunity to buy a property really undervalued, put some money into it, and then turn around and create a long-term rental, the DSCR program would be great. Where it really comes in handy, couple of things. If you have maxed out on your Fannie Mae, Freddie Mac lending, meaning you've got 5 or 6 properties already financed, we can continue to do business using the DSCR product. We actually have multiple investors now under that DSCR label that we can continue to do deals in excess of 10. That's great. 10 deals, $2 million for one particular investor. If you meet that limit, we can go on to the next one. We can close those deals in the name of the LLC, which is always a hot button with a lot of investors, especially as they grow their portfolio. They would prefer to keep the property in the name of their LLC rather than their personal name. And then for folks who might be getting out of the workforce, saying goodbye to their W-2 job after a bunch of years, and they want to jump into real estate as their second career, they don't have to worry about, can I qualify for a home loan on a rental, because we can do a DSCR transaction. And I think you've worked with some folks who are looking for like their second career.
Absolutely.
Yeah.
Absolutely.
I think that's a neat next stage in life kind of thing.
Definitely. And one of the points too about the DSCR loans, you're kind of falling into my area as far as the amount of paperwork that you need, the amount of qualifiers and things of that nature. So I think that's good for a lot of investors.
Yeah. The Fannie Freddie route can be a little paper intensive, and it's like, well, Lawrence didn't ask for that. The DSCR route, like I said, is focused on the property. We still have a credit report. We still have a credit score minimum. We still want to see some reserves, but to the extent that we're looking at personal income, we're not.
Also, too, it helps too is I would say probably 70% of the loans that we fund, we're funding in the name of the LLC.
Yeah.
So it's an easier process for them because the DSCR loans are only funded in the name of the LLC.
So you're sending me more business is what I'm hearing.
Absolutely. Of course. Of course, man.
One of the little nuances that we found out, this was kind of cool. In the normal world that I operate in, it's always we take the middle credit score, and if there's more than one borrower, we take the lesser of the middle credit score.
Sure.
The particular DSCR lender that I prefer to work with actually will use the highest credit score. I'm like, oh, that's a switch. I'm not used to that one. I told our marketing rep from that company, I said, man, you don't press that enough. He goes, yeah, that's a given. I said, it's not a given in the world that I live in. So there are some minimum credit scores required. And with a DSCR, a couple of things fall into place that are really important. The loan to value of the property, the debt service ratio as well as the credit score. Those three things are probably some of the biggest determining factors in terms of interest rate. So if you got a deal that you're looking at, I would say just give me a call. Let's look at it and figure out, okay, is this going to fit the box? Because there still is qualifying, but it's a different set of qualifying.
Gotcha. Let me ask you this, Frank. Now I'm interviewing you.
All right.
Let me ask you this. As far as seasoning, because I run into that.
Yeah, so that's another big break that we got when we went to the DSCR, because Fannie and Freddie require a full year to do a cash out refinance on a property to use the new appraised value. Up until that point, we got to use acquisition cost. We could still do a rate term refinance and pay off an existing balance, but we can't do cash out. Now with the DSCR, we can do cash out after 6 months seasoning. Most of your terms are 6 month deals, aren't they?
Yes, yes. But a lot of my, I would say probably 2/3 of my investors, though, they're just looking for rate term refinance.
Right.
Is it still seasoning on the rate and terms, or is it just the cash out?
Yeah. So there is no seasoning on rate term. There is seasoning on cash out.
Yes.
And so that's the little niche piece that I'm looking for in terms of people who use the call and say, hey, I bought this property 3 months ago. It's now worth this. How much can I get out of it? And my response was, call me another 9 months.
Gotcha.
Yeah.
Gotcha. Because I have a lot of investors that are they're quick through the renovation process.
Yeah.
So it might be a $20,000 renovation and they're doing $5,000 worth of renovation a week. Yeah. So they're out of that, in 4 weeks, and then they're ready to refinance. So they can come right directly to you and do a rate term refinance through the DSCR loan program. And then, I think that's a great opportunity.
Yeah. And I think I used this term. I think I talked about this in our very first podcast, which was darn near same time we were sitting at Calypso's, if I'm not mistaken, and it was coming right up on Mardi Gras. But I think working together on this, using hard money to build a long-term portfolio is the force multiplier, because it takes less money up front to get into the property. Absolutely. Then you increase the value of the property, then you refinance from there, and you haven't had to put as much cash into it if you do it the right way. And that is the acquisition plus the improvements based on the appraisal that you guys do, right? And the analysis that you guys do.
Yes.
And avoid putting in a 20% down payment using the old Fannie Freddie method. Avoid running up the Home Depot credit card, or avoid running up the Lowe's card, which, by the way, is at 30% interest. This is a much better combination, and it's repeatable. That's the beauty of working together with us, because I just don't, people will take that initial, oh my gosh, Lawrence's interest rate. Again, compare it to Home Depot or Lowe's, yours is a bargain.
And not only that, when you really think about that, I love when people ask me, well, hard money's too expensive. Well, just think about this for a second. We lend 100% of the purchase and renovation on, I would say, 95% of the loans that we fund. We don't have an experience requirement typically. So we'll fund a new investor. What would you charge?
Right. Yeah. If it was your money, what would you charge?
Our fee structure is commensurate with the amount of risk that we take. And one thing that you said too, hard money is about leveraging your capital.
Yeah.
We have a small requirement. We want to see 15,000 in reserves, but I've seen people get in and out of transactions. We'll fund the purchase and renovation. We'll send them over to you. They'll do the rate term refinance, and then we just rinse and repeat as many times as we can.
That's what BRRRR stands for, right?
Yeah. Buy, renovate, rent, refinance, repeat.
Right. Get all the R's in there.
Yes.
Orlando Askins, he nailed it when we talked to him back in December, and he goes, it's short-term money. He's like, I don't know why people are upset about the interest rate. And I will tell you this, the first time that I met Lawrence and I found out his rates, I'm like, well, I don't have to be worried at all about my rates now, but mine are long-term rates. Right. So that factors into the, people are saying, hey, rental rate's going to drop, water rate's going to drop. I'm telling you, don't worry about rates. Does the deal make sense?
Absolutely.
Can you do the acquisition, the fix-up that you're proposing with Lawrence? And then do the DSCR numbers make sense? And I think those are the real critical things you got to look at. I would not fixate on, Frank, are you at 7.5 or 7.75 on your DSCR?
And I think people are just programmed that way
They gotta
because
have
from an owner occupied standpoint, I think they're programmed for that. But mentioning interest rates too, I really haven't had a client say, you know, really anything about their interest rates because most of my clients are professional real estate investors. So if the interest rates go up or they tick up even a point or so, they're not going to change their careers.
Yeah.
They're going to continue
to do what they do.
to do what they do.
Right.
You have to work a little harder, but still you capturing that equity piece.
Yeah.
And then eventually the rates will go down and then you have some flexibility there to do some refinancing and things of that nature. But they're still capturing that equity position. They're still getting into these properties with little or no money out of pocket. And they have an opportunity for us to fund these transactions and then rinse and repeat and do the same thing over and over and over to help them capture that financial freedom that everybody's looking for.
Yeah, I talked about the retiree game plan. There's a number of my buddies who are at a certain age. I'm not going to say what it is, but they're looking to see what they're going to do now that they've left the W-2 job. And I think real estate is a great opportunity for them, right? They've got some capital that they've set aside through savings. They've got time on their hands. They can go out and look for a property. Maybe it's a little bit roughed up. They can fix it up, get it up to highest and best use, rent it out. Whether they work with a management company on that or not, or whether they're taking the phone calls, they're seeing that property appreciate. They're now seeing some tax benefits.
Absolutely.
And then they're building a portfolio that will pay them for years to come. I think it's a great strategy for anybody who's eyeing up retirement in the next few years.
And not only that, a lot of my senior investors, and I'm a senior too, a lot of my investors, they think it's fun.
Yeah.
Because you figure every other program, HD, and not just HDTV, but there's a ton of programs that are talking about real estate, things of that nature. A lot of my investors are self-performing. So it gives them the opportunity to get their hands dirty, keep themselves obviously super busy while they're continuing to make money and build wealth for themselves and generations to come.
Yeah. Well, and then there's multiple avenues of it, right? There's the traditional long-term rental that I think everybody has in mind. Then there's intermediate. So you're talking about traveling nurses who need a place to hang out for 3 to 6 months while they take a gig here. And then you're talking about the Airbnbs that potentially, you're just doing weekends and things like that. So there's so many different ways to run at this thing now than there was when certainly I first got started. You say a buy and hold, you're talking about a 4-family, that you rent out on annual leases, and that's just not the case anymore.
Right. And remember, the word flip used to be a bad one.
Yeah.
Now it's about the mainstream real estate goes.
Right. Yeah. I mean, that's on TV all the time now, right? Like you said, HGTV.
Absolutely.
I just think there's so much opportunity, especially in St. Louis. Again, Lawrence and I deal with a lot of folks from out of town.
Yes.
Who come here and they realize the opportunity that St. Louis presents.
Yes.
Our prices are affordable.
Yep.
I would say that we're relatively speaking a landlord friendly location.
Absolutely.
Absolutely. There's a lot more that are not landlord friendly.
Right.
Nuances over multiple municipalities can cause some grief to some people. Yeah. If you stay in St. Louis City, you only got one set of rules to live by, right? That's a good one. But St. Louis just has an incredible opportunity for people. And so that's why we do on a regular basis deal with the people from the coast. They just freak out when they hear our sale prices.
Yeah, they sure do. And there's a lot of diversity in St. Louis. Yeah. You can go South St. Louis where you can do the multifamilies for rentals, U City for multifamilies for rentals, but there's a lot of areas that, to do flips as well. St. Charles, Jefferson County. We're doing a lot of work in North and South St. Louis now, so there's opportunities there. Only thing I tell investors is don't bite off more than you can chew, and this might be something that we've repeated over and over, but I see it every day. We're a brand new investor. You live 800 miles away from St. Louis. Their only contact in the St. Louis market is the real estate agent that's acting as their project manager that connected them with the general contractor. and they're starting on a renovation of a 150-year-old house that hasn't been occupied in 10 years.
Has a tree growing out of the basement.
Yeah,
Those that's
things.
probably not the first,
No.
the right first.
No, and we will turn those people down. That's, I'll be extremely polite about it, but we'll turn those people down because we have enough data to show that those people are going to fail.
Yeah.
And
And we talked about this last time. Failure, it's okay if you learn from it, but we don't want to set you up for failure.
No, yeah,
Right.
yeah. And again, we funded close to, I would say, 8,000 loans as a hard money lender since 2008 in multiple cities. So we have enough information to know, like, this is not going to work. Now, not to say that there's not the
unicorn out there.
There's a few of those people that have done a good job with that, but for the most part, I would say start with $30,000 to $40,000 renovation. Start in, I love Florissant, Ferguson area because the houses were built in 1970, so you're not dealing.
South.
Yeah, you're not dealing with all the craziness, knob and tube, wiring, and all of that stuff. So you most likely you're just going in and doing updates, even if it's updating plumbing and electrical. It's still, I would say, it's still mostly cosmetic.
Right.
Now, people are attracted in St. Louis to the margins, into the bigger houses where they want to. Well, I can make $150,000. I'm like, yeah, but to get to the end of the rainbow, where you see that pot of gold, it's tough. And I see a lot of people crash and burn. So
what's the biggest loan you funded here?
Me,
Put you on the spot.
I would say 750,000. Combination of purchase and renovation, maybe a little more, maybe a little less.
That's a big number.
Yeah. We don't. We will fund them if the deal makes sense.
Yeah.
Meaning we have to have a borrower as well capitalized. We can't have somebody with just the minimum there. And then with that, it was probably a house that was purchased for $600,000 and only need maybe $30,000 or $40,000 of upgrades and things of that nature. So we wouldn't do like a $500,000 rehab, because again, it's a 9-month term at maximum with us.
Right.
So anything, I think our biggest rehab has been $170,000, something like that.
Yeah.
But on average, $50,000 to $60,000 is what we're looking for because if it's a 6-month term, I don't care if you're Bob Vila. It's tough to get.
You're showing your age there.
Yeah, I know.
You should have seen Chip or JoJo or somebody like that.
I should have, but it's tough to get through the renovations, and not to be critical of the municipalities or the city, but the process to get drawings approved, the process to get permits can be a little stagnant at times. So not only that, but you're dealing now. It's been 6 degrees in St. Louis. So nobody wants to work, or you can't efficiently work on a job site.
Or you show up on the job site and pipes are frozen.
Right. Yeah. It takes 8 to 10 weeks to get windows, depending on the company you're working with. So it's just most clients have a tough time getting through a giant renovation in 6 to 9 months.
Yeah. That's a good point. It's the only reason I brought that up is because you and I tend to run in a range. But I didn't even know what your maximum was.
No, we have a minimum.
Yeah,
we do have a minimum.
That's a good point.
Yeah, our minimum is $100,000 for any combination of purchase and renovation, and then we want to see a minimum after repair value of $150,000 as well.
And that's a good. I'm glad you brought that up because our DSCR product minimum loan amount on that is $100,000. So again, these lines are starting to come together perfectly for us.
Absolutely.
But loan amounts are rising. I did a review of my business this past year, and I was shocked by where the loan amount ended up. And that's just a function of real estate prices continue to rise. If you're betting on a crash, it ain't gonna happen. We have a shortage of houses. Mm-hmm. We need somewhere close to 4 million properties brought on board to meet the demand. St. Louis has, I just looked at the LRA numbers of how many vacant properties they were sitting on.
That's a lot.
It's a lot. They're sitting on a lot of vacant lots.
Yep.
You do a construction program too, do you not?
Yes, we have a new construction we have a new construction product. We basically lend 90% of costs. If the land is already acquired, we'll go up to 100%. But I haven't funded too many of our new construction products here in St. Louis. But our only main requirement, because the same relative requirements, the same relative pricing as our fix and flip program, but we want our investors to have experience with new construction.
Okay. Yeah. Because if you're going ground up, you need to know what you're doing.
Absolutely. And then even if we see a a fix and flip and it only has 3 walls, it's basically new construction too. So we want to see folks just to have some experience in that new construction realm for us to fund it. But what we can do is we can fund it in 2 weeks instead of it taking 6 to 8 weeks and things of that nature.
So hey, you just got back from Dallas,
Yes.
the big Longhorn meeting.
Yes, we had a conference.
Anything really cool that you brought out of that, learned from that, want to announce from that? I know they had to have something.
Yeah, no, absolutely. It's always a great time, and it's always great to see my counterparts in other markets.
Yeah.
And we get to share ideas and the challenges they're going through because we're basically all remote. So the challenge to see each other, to get together, to share ideas, and to know that I'm not alone in my challenges. I think it's a beautiful
It's always
thing.
good.
Yeah, and our company is continuing to grow. We're doing some great things. I'm looking forward to 2025 and beyond.
Yeah, so we have our big leadership summit next week down in Dallas, Arlington to be exact. But that's why Lawrence and I got together and said we got to get this done because you just came back. I'm getting ready to leave, so let's get this done. I was shocked that they let slip the DSCR program because I thought that was going to be a big splash announcement. Maybe they have something else coming my way. I don't know.
Yeah.
But you're right. It's great to get together with a bunch of your cohorts from all over the country, share experiences, share stories, challenges, uh, you know, and successes.
Yeah.
And you come out of that just fired up.
Oh, definitely. Definitely. I could wait. It's always kind of a drag traveling, in
It is.
particular when it's 5 degrees out and that. So my wife kind of nudges me out of the car, bless her heart. But in the airport coming home, I'm just fired up.
Yeah.
I'm like, I can't wait to get home and start implementing some of the things that we've learned, start telling some of our clients some of the things that are happening with our company. So I'm excited. So we're gonna take that excitement and I'm gonna make sure it carries throughout the year because I have some some healthy goals for 2025.
Yeah, I set some pretty healthy goals for 25. 24 turned out to be a pretty darn good year for me.
Yeah. Good.
Way better than 22 and way better than 23.
Mm-hmm.
And so I think that 25 will be a great year. You can fixate on what's going to happen with interest rates. You can fixate what's going to happen in Washington, D.C. with our leadership. Control what you can control, do what you can do, and just move on. I think we're poised for some great stuff this year, and I'm looking forward to it.
Yep, and I'm glad we're in a tremendous market. I tell real estate investors, I think St. Louis is the best market to invest in real estate, in my opinion.
Yeah.
And I'm a little biased.
Yeah.
But I think there's some tremendous opportunities. We're already off to a great start. 200 loans is my goal. $35 million in
That's a
loans.
big number.
That's a big number. But it just happens one loan at a time.
Yeah.
Just one loan at a time. So I tell you what, Frank, I'm glad to be back. 2024 was a great year for us. I'm looking forward to 2025. I think it's going to be, like you said, a great year. And we're going to do some dynamic things with the podcast. So I'm excited about that. And I think we're going to have a few guests on.
Yeah. We'll do some, but we needed to spend some time with us.
We did.
Yeah,
you sure did.
we do a really good job of talking other people up. And we had some great guests last year. We kicked it off with Rich Groves.
Yes.
After the Gateway to Freedom event. Orlando was awesome. That was a really cool event. Just checking out his building down there.
Yeah, it's renovation.
Cool.
Yeah. Having
Erica, that was cool.
Yeah.
And then
being live at the Gateway to Freedom event.
Yeah, we did the live.
Yeah.
That was a lot of fun.
Yeah, and then we got to figure out how to maneuver through grabbing different folks.
Yeah.
Jason Coverly.
Yeah.
The 4D
folks.
Yeah.
I got Julian Andes on there.
Yes.
Julian runs a home inspection operation, both sides of the river. Former military, Air Force over at Scott Air Force. He has now transitioned to full-time doing home inspections. Great guy.
Okay, good.
Trying to remember who else we grabbed up, but yeah, that was a great event. I know Rich wants to blow it out of the water again. But I tell you what, we're looking forward to 2025, and I know that if you guys have any need in terms of buying a whole financing, I've got a lot more options to offer that.
Great. We're the same. one trick pony, in my opinion. We're very, very good at what we do: fix and flip loans for real estate investors. Minimum credit score to get involved, minimum asset requirement to get involved, and we get you to the closing table in 7 to 10 business days.
Yeah.
Some of that
Footnote.
you know what I'm about to say is the speed of us getting through that underwriting process is dictated by our borrowers providing us information on a timely manner. But typically, we're 7 business days from the time we get your file and underwrite.
So let me ask you this, because I'm not sure if I ever somebody can come to me and get pre-approved, but we can have an approval kind of hanging there without a property. Can they do that with you?
Absolutely. Absolutely. I can send them a link and they can fill out an online application. It takes about 5 minutes to complete. And I can issue a pre-approval letter just based on doing a soft credit pull. And it's good for 90 days.
So you said something that's great there. So we work off of a soft credit pull initially as well. So if you were at all thinking about maybe 25s a year, I try to start investing. You could talk to Lawrence and get your fix and flip or just your buy and hold renovation project pre-approved. You could come and talk to me and say, okay, Frank, what could I do here? What are the parameters, whether I go Fannie, whether I go DSCR? Again, soft pull credit report, getting pre-approved. And then you could actually go out and start shopping.
Absolutely.
And know that the two of us
you have your
back.
Right. And you have your grocery money.
Right.
Because you have your pre-approval letter.
Yeah.
Absolutely.
So how cool is that? And I don't know that every investor knows that. I'm going to tell you, maybe I'm wrong, that it starts with, hey, I saw this property. I want to write on it. Can you get me that approval this weekend?
Right.
I'd love to do that. But wouldn't it be cool if we just had that paperwork done ahead of time?
Right. Now, I can move, because I can issue pre-approval from, if they do the online application, I can issue pre-approval from my cell phone.
Yeah.
So I can basically do it 24/7 if they need that pre-approval letter.
I could probably do it from my cell phone, but I don't know how.
Gotcha.
I was going to say that. I need my laptop. But again, I think if you're really serious about jumping into us and you don't have a property in mind, call us.
Absolutely. Absolutely.
And we can then figure out, okay, what are the parameters? Where should I be looking at? What price range? Are we talking about, as they refer to, a light reno? Certainly avoid a heavy reno if you're not equipped to do that.
Exactly.
And then do you have your team in place to do that?
Right. No, absolutely. That was episode 2, was building a team, right?
It was.
Yeah. I think we need to expand on that too, as we go through episodes. I tell you what, Frank, I think we did it again.
Yeah.
I think we knocked another one out of the park, gave some good information, and I'm looking forward to the rest of 2025.
Absolutely.
All right.
See you guys soon.
All right. Thank you.
Here we go.
Money, making crap for money.